Most people believe banks simply store money. You deposit your paycheck, the bank keeps it safe, and when someone else wants a loan, the bank lends money that someone else deposited. Simple, right? But what if that's not actually how it works? What if banks don't just lend money? What if they create it? Not by printing bills like governments. Not by mining gold like ancient economies. Right? But by typing numbers into a digital ledger. If that sounds unbelievable, you're not alone. Yet this system, known as fractional reserve banking, quietly powers the entire global economy. And once you understand how it works, the way you see money may never be the same. Centuries ago, banks worked very differently. Early bankers were essentially vaults. People deposited gold and silver for safekeeping, and the bank charged a small fee to guard it. But bankers noticed something interesting. Most depositors never withdrew all their gold at the same time. So instead of leaving all deposits untouched, banks began lending out a portion of what they held. A small loan here, a small loan there. But over time, the practice evolved into something much bigger. Instead of lending only existing deposits, banks began expanding credit far beyond the money actually sitting in their vaults. This system became known as fractional reserve banking, and it changed everything. In a fractional system, banks keep only a fraction of deposits as reserves. The rest can be lent out. Here's where the cause and effect chain begins. When a bank issues a loan, it doesn't hand out someone else's money. Instead, it creates a new deposit in the borrower's account. That new deposit can then be spent, transferred, and deposited into another bank, which can then lend a fraction of it again. The result: one original deposit can multiply throughout the banking system. Money expands not through printing, but through lending. This is how modern economies fuel growth. As economies industrialized, the demand for credit exploded. Businesses needed loans to expand. Governments needed financing for infrastructure and wars. Consumers began borrowing for homes, education, and spending. Fractional banking allowed the financial system to scale rapidly. More lending meant more investment. More investment meant faster economic growth. Central banks eventually emerged to stabilize this system, setting reserve requirements and acting as lenders of last resort. But the deeper the system grew, the more dependent economies became on continuous credit expansion. Growth started to rely on new debt creation. However, fractional banking contains a built-in vulnerability. Because banks hold only a fraction of deposits, they cannot satisfy everyone withdrawing money at the same time. This is what causes bank runs. Depositors lose confidence and rush to withdraw funds. Banks can collapse quickly. History has seen many such moments. Financial crises often begin when credit expands too quickly, asset prices inflate, and borrowers struggle to repay loans. When defaults rise, lending slows, and the money supply effectively contracts. Suddenly, the system that created money through loans begins destroying it. When credit collapses, the effects ripple across the entire economy. Businesses lose financing. Consumers cut spending. Asset prices fall. Governments and central banks usually step in at this stage. Interest rates are lowered. Liquidity is injected into the financial system. Banks receive emergency support. These actions aim to restore confidence and restart lending. But they also reinforce the system's dependence on debt-driven money creation. Over the decades, regulators introduced safeguards, deposit insurance, capital requirements, central bank oversight. These measures reduce the risk of collapse. But they do not eliminate the core dynamic: money creation through lending. Every expansion cycle encourages more borrowing. Every crisis leads to more intervention. And each cycle begins from a higher level of debt than the last. Today, most money in circulation is not physical cash. It exists as digital bank deposits, which means the majority of modern money originated from loans, mortgage loans, corporate loans, government bonds. Global debt now exceeds the size of the world's economy. Because money is created through lending, reducing debt too quickly can shrink the money supply, triggering recession. This creates a paradox. The system depends on credit growth to remain stable. Yet too much credit eventually creates instability. First, banks don't just store money, they help create it through lending. Second, fractional banking allows economies to grow quickly, but it also introduces financial fragility. Third, because modern money is tied to debt, economic stability often depends on maintaining confidence in the credit system. Fractional reserve banking is one of the most powerful and least understood systems shaping the modern world. It quietly determines how money enters the economy, how markets expand, and why financial crises occur. Understanding it doesn't just explain banking, it explains how modern economies function. If you want to uncover more hidden mechanics behind money, global debt, and financial power systems, subscribe for deeper breakdowns. Because the biggest secrets in finance aren't always hidden. Sometimes they're simply misunderstood.